What's up, Resource Nation? We are here with Logan Mohtashami, and we have a masterclass series for the ages, man. Because Logan is legit, and I have dug into his stuff for the last couple of days. He wrote a really interesting article that we're going to distill, actually 2 articles, but he's coming to us from Irvine, California. Appreciate you being with us today, Logan.
It's great to be here. Thank you for having me.
So you got your AKA the charts guy, the housing guru. I've read. You've been on Bloomberg. I've read stuff on Bankrate from you. Really just a national housing data analyst. If you don't know Logan, we're going to put all the links to his stuff down below. But man, you wrote a really interesting article last week, kind of making fun of the housing bubble boys, you called it, and I loved it. I thought it was amazing. You also have a really good article called America is Back. And you've updated that a few times, I think, since you originally wrote that. And I want you to cover both of those because last week we kind of highlighted some delinquencies and we talked about the rental forbearance challenge. And we didn't really cite either way like what we thought was coming, but you've done some amazing work. I mean, you've dug in at an amazing level, and you'll see one of the articles we post for Logan. All his homework is there. Like, he shows his math. And it's all there. So can you catch us up for the realtors, the lenders, consumers that maybe haven't read the HousingWire article and then also the America is Back article? Can you distill both of those for us and just get us caught up?
Definitely. I think for me, for the last few years, I've been talking about how the bubble boys are just more of a marketing gimmick. They're not actually real data people. They just do it just for clicks and citing and stuff like that.
Right.
So, but you have to show them why the housing market isn't a bubble. And to me, it's just more or less that bubbles don't happen in the same exact sector back to back. So when people talk about housing was going to crash earlier this year, I listed a few things early on that, inventory is just not going to skyrocket. These homeowners are the best homeowners I've ever seen in my 24 years in the business. You have
Right.
nested equity, fixed low debt costs. So after a few weeks, you could see that the housing market wasn't crashing. So what bubble boys usually do is they move the goalpost next year. They do this every year. This is year 8. So they're going to do year 9. So now I've switched their names from the bubble boys to the Forbearance Home Price Crash Bros. Because now it's it's all about the forbearance crash. And I think what I want to try to do is give a different picture based on an economic model on these homeowners versus the past. And I think forbearance is a little bit confusing because you see people talk about a foreclosure crisis. A foreclosure crisis typically means people that don't have equity, and then the following year, home prices actually fall, and they lack equity right there, selling equity, and then job losses. This is the exact opposite. We took this internal shock now in that Forbearance Crash Bros article. Hey, listen, we've got 10.6 million jobs back. Now, all these people that own the homes, they own the debt, right? They fixed low debt costs versus rising wages. So if they lost their job and they got a job back, most likely maybe 4, 5, 6 months after, they're going to get off the forbearance plan because these are homeowners. These are not speculators. There's a big difference. Speculators, they don't really care about, they don't live in that homes. Their kids aren't going to go to school. They don't know their neighbors. There's no vested interest. These are homeowners. So they have equity, they get the job back or any kind of income back, most likely they're going to stay in their home.
Well, and
right?
forbearance numbers are inflated too. I mean, I'm on the street level, and I know how many people, I know several of my friends and family that unfortunately took forbearance and didn't need it. And so you got a lot of those numbers that are inflated that are just like, oh, I'm just going to take it because it was there type thing.
Yeah, and that's part of the problem with the forbearance. If you look at it, it was, I think, 3.7 million loans are in forbearance. We had about 15 million loans that were like in delinquency or some stage of delinquency after the housing bubble years. The housing bubble years, real home prices took off for 3 straight years. Home sales took off, debt took off. The exact opposite, mortgage debt adjusting to inflation is not even positive now. So you just don't have the similar backdrop. And then with forbearance, that's why I tell people, wait until December. Let's see what the forbearance data looks like. And then also, hey, 2021, whoever wins the presidential race, you think that person is going to say, oh yeah, by the way, if you are going to foreclose, which I don't think is going to happen, but if you are, we're not going to extend forbearance. So there's all these different variables. So don't go into the crash crowd already so you don't take 2021 and move the goalpost to 2022, right? Be a little bit patient. Realize that nested equity means they can sell the home. Now, 2018, 2019 FHA home buyers might not have enough selling equity, especially with the mortgage insurance added up front in the balance. But for the most part, these people are going to be okay. Now, forced income selling is something I'm going to go on to more details later on. But that is something that, if somebody doesn't get their job back and they don't have enough income, then they could put their home on the market. But I would argue that if they knew that to be the case, some of these people might have already done that. We just don't see that kind of velocity in inventory. So don't assume everything is going to be a 30 to 40% crash price, because really the forbearance is so small compared to the biggest housing demographic patch ever recorded in history. And we're talking about years 2020 to 2024. We've never had so many people ages 26 to 32 going into their first time homebuyer age of 33, right? So you have a demographic a backdrop to go along with nested equity in a rising price year. So it's much different than in 2005, where mortgage demand was falling, housing demand was falling,
right,
and debt was inflated. It's just completely the opposite cycle. So be skeptical of the bubble boys and now the forbearance crash bros.
I want to, in the green room you were talking about before we went live, I want you to talk about, you had a date in mind as far as how positive you are on housing. But also with the America is Back article that has been updated, and you guys really need to dig into this. You mentioned 5 indicators. I wrote them down so I didn't forget, but flatten the curve, end stay-at-home orders, 10-year yield above 1%, decline in credit stress and jobless claims, and then data from hardest hit sectors start to trend upward. How do you feel about those 5 indicators from the original time that you wrote it to now?
Yeah, so April 7th, with the information that I had, I thought, okay, we're going to separate 2020 into 3 categories: BC, before coronavirus; AD, after the disease; and AB, America's back. Because 2020 should be there. And people thought, you're crazy. We're going to be in a depression for 3 or 4 years. We're 30% unemployment rate. So I was like, okay, that's fine. If this doesn't work in 2020, then you got me. So really, number one is that we weren't going into a recession, right? So there was no credit stress. Employment was high. There's no overinvestment thesis out there.
Can I start a question on that? So many people assumed, and was it just because of the long run, the 10-year run-up, that we were just overdue for a recession? So if you were to play the other side of that, why do you think that they thought that was like a foregone conclusion that we were going to head into a recession?
Those are what I call podcast stock traders, right? So they see the unemployment. Every year is the same thing. The unemployment rate is low. When the unemployment rate is low, that means the recession is about to come. Okay, that hasn't worked for years. The inverted yield curve, something that I actually forecasted at the end of 2017 for 2018. They think, oh, here we go. This is it, right? And then the repo recession, man. They have all these little gimmicky things. What happened is toward the end of 2019, the economic data got a little bit better. And then in 2020, the first 2 months, the economic data noticeably got better. So there wasn't any recession. So the fear of the virus, right? It wasn't just lockdown protocols, but the fear of the virus. We were hoarding toilet paper in March, right? And then, so all of a sudden we have this longest expansion ever in history. And now we have an open virus that could be killing people. So everyone kind of froze. And then if you took a model, basically the 5 things that I've talked about, number one, you have to flatten the curve. People have to assume that, they're not going to go out and die. I said May 18th. By May 18th, if we take all the data that we have, around the world, May 18th, things should get better. By May 18th, we did flatten the curve. Okay, that's number one. Number 2, what we need to do is see credit stress get lower. Now, credit stress is so important to every economic cycle. And so the St. Louis Financial Stress Index, okay, it's a component of 18 different things. When that spikes, bad things happen, right? And we saw a huge spike earlier this year, and then it started to come back down when the Federal Reserve got in. So credit was getting better. Jobless claims needed to fall, right? Jobless claims, continuing claims, even though they're historically very high and we have so much work to do, I don't want to discount that. Continuing claims started to fall. And then what happened? Jobs started to come back. So those are good. The stay-at-home orders, right? We never really had a full-fledged national stay-at-home order, so nobody kind of knew who was doing what.
Right.
But by May 18th, I thought, some of the stuff will be alleviated, and that was the case. Some of the restrictions were taken off, and I'm not going to go into the second surge of cases, but that also was part of the AB economic models. Stay-at-home orders go away, flatten the curve, credit stress gets better, continuing claims, unemployment claims starts to fall down, job growth is coming up. The hardest hit sectors, right? Retail sellers, driving, going to bars, restaurants, open table,
Yep.
those things start to come up. We have unbelievable sticky economic data that just went like this, just fell down. Things that would never historically go down unless you have a virus. So these are going to naturally bounce back up. So those kind of sectors start to show recovery. Then we start to get back to what? Always having over 133 million people working, even in the worst days of COVID. And I think there's the disconnect with the housing market. When housing started to come back, people go, how is it possible? Millions of Americans are unemployed. How could people buy homes? Completely neglected that we always had 133 million people working. And you just need 4 million new mortgage buyers a year just to keep it stable, because we have about 15 to 20% cash buyers still. 133 million people, 4 million mortgage buyers a year. It's not like totally out of the realm. So all of a sudden, mortgage purchase applications started to come back up, and now they're positive. This goes into that demographic demand. But the last thing that we don't have yet is that the 10-year yield goes above 1%. We really wanted to get above 1.33%. Once the bond market is convinced that growth is there, and it should, we're just bouncing off from a very deep bottom. In time, we're going to get steady 2 to 3 years of 2 to 3 quarters of GDP growth. The 10-year yield should be above 1% there. That's the last thing that's left on that AB economic model. It was written on April 7th. I've done a few updates and on my blog, the most recent one, because I had these certain dates, September 1st. Like by September 1st, we have to be in a much better position. And if this model works, we should be there. And if you look at all the economic data, all the charts, we have these V-shaped recoveries. Retail sales, manufacturing, durable goods, housing, everything is coming right back. Why? Because the majority of the people are still working, and those that are unemployed do have some kind of fiscal monetary stimulus in terms of getting them checks. So you pretty much have everyone there. Some people have a lack of choices of things to spend on. There's certain sectors, of course, airlines, people aren't traveling, convention stuff. There's stuff like that that we just can't have an economy running at full capacity. But if you follow the model from April 7th, which I know people are thinking, you're nuts, you're crazy, this is never going to work in 2020, and you correlate it to the economic data itself, we're here, right? Things are much better than they were in March and April. And that's why economic models matter. And going into the fear thing first and not assuming that, we're going to have a recovery. Twitter Finance is really good at this. They are behind the curve, right? Yeah, we're just behind the curve. And just like the Great Recession, people didn't think, well, we're ever going to recover again. Here, it was much sharper because it was a much sharper decline. And even today, I still think people are just too bearish on the United States of America because we have, inflation is low. We have the ability to borrow money. We can inflate this economy and give people checks until they can actually get back to work in those certain sectors that have a hard time. So,
speaking of those checks, though, how do you think that's going to play out as we get into winter and some of that stimulus support dries up? I agree. I think I'm very bullish on housing. I think in the green room you said all the way through 2024, which I want you to touch on. But speaking of those checks, does that come into play at all with the unemployment and PPP money drying up?
To me, you've got about roughly 30 million Americans that have some form of a government assistance. Transfer payments is how I look at it. Our savings go up. We had a savings cut, the biggest savings rate ever recorded.
That was an interesting graph you posted.
Yeah, and I put those charts in there. And I was talking, this is like the backdrop for the roaring 20s, right? We have all this savings here. We have to spend it. Now, savings rate has been falling. Retail sales have been rising, right? So when you deal with politics, it's the word itself, politics, many blood-sucking parasites. So you just don't know what's going to be done in an election year. But it's not because of that. We have the capacity to do this. And I think if you don't have the capacity to borrow and facilitate, then you have to look at the economy different. I just don't see either party really just pulling the plug when we still need about 11.5 million jobs left to get back to where it was. But again, 11.5 million jobs, unemployment rate 8.4%. This is not the 20 or 30% unemployment rates that the housing bears or the American bears have been talking about, that we would be in a depression for a while. This is a very fast moving year. So we just got to work our way until we get a vaccine. And then when the vaccine game's on, a lot of these bearish theories that are being systematically taken out each month. And by the time they realize it, oh, we didn't collapse completely. We are getting better. It'll be too late for them.
So you mentioned that you kind of think the support's going to be there. It might change. It might look a little bit different as far as some of the stimulus. What are the long-term ramifications? I mean, we spent trillions with with a T to help. What are the long-term ramifications of that? Should we be concerned of those at all?
The very last thing in the world I'm worried about is federal debt. It is. I even wrote an article last year talking about, before this happened, we're going to 71 trillion in debt. Federal debt is kind of a political boogeyman. We are the reserve currency of the world. People say, well, America's broke. They have $25 trillion in debt. We're a $140 trillion GDP financial asset country. So if you want to do the household gimmick games, we have $140 trillion here, and you're talking about 25 trillion. Okay, we're 100 trillion surplus. We're good. Politics prevents us from borrowing more, and I understand that game. There's no other country that comes close to us. So I'm never worried about the dollar losing the currency. If anything, one of the things I wrote early on, I think the dollar is going to get too strong. That'll be a problem. You saw the dollar actually get stronger during the early parts of the crisis. It's starting to come back down. The dollar collapsing, inflation, gold bugs, or anti-central bank people I call them, are the biggest American conspiracy bears of our lifetime. They've been here since 1913. Pretty much almost everything they've talked about has failed. So don't worry about federal debt. Know that we're always going to underspend because our politics don't allow certain things to happen. But tax rates have been falling for decades. Debt has been rising. Inflation rate of growth is slow. Our borrowing yields are low. Japan has like 250% debt to GDP, and they're borrowing a negative rate. So don't fall prey to the higher inflation, higher rate story. I'm that grandkid. Politicians always go, oh, our grandkids are going to have to pay 200% of their income in taxes. Okay, I was that kid in 1980 at 5. My grandpa told me, you're going to be paying all the borrowing.
That's hilarious.
My tax rates are lower than ever, right? Borrowing costs are lower than ever. So I was that grandchild that was supposed to
inherit it.
Yeah, and didn't happen. It's a gimmick. It's always a marketing gimmick. Other countries, smaller countries and third world countries that have to go against the dollar, they have problems, right? Why is there a euro? Some of those countries don't want to have their own currency against the dollar. We are king dollar for a reason. So just be very skeptical of the person who's always going to say, we're broke, we can't borrow. Look, we just borrowed over $10 trillion, really monetary and fiscal, within months. And the 10-year yield is still under 70 basis points. Yeah. So I am not concerned at all about the federal debt for the rest of the century.
Love it. I got one more question, then we'll go to closing statement. But we kind of touched on this already, and we quoted a USA Today article, I think it was. It might have been Washington Post. But they quoted 43 million Americans, or 25% of the adult population, either didn't make their mortgage or their rent last month and don't feel confident they can make it next month. You and I kind of discussed the forbearance thing and why we're not too concerned on that. What's your thoughts on the rental issue that's being talked about right now? Because there's a kind of an eviction ban that's going to go through all the end of the year. Some of the some people are saying that that's going to be a pretty big cliff once the ban is lifted, if it's lifted, because those people are going to be able to keep up their rents.
So renters were always going to be the high financial risk group in the sector. In fact, when I did one of my earlier interviews with Bloomberg, I said rent are the people, because majority of the job losses are actually renters, right? So the kind of the fiscal cliff people are talking about is that if you just dry out all the unemployment benefits, there are certain renter households that just won't be able to make their payments. To me, that's not the risk that we saw during the housing bubble years, where banks didn't trust each other, right? Third-party risks, credit default swaps. We're actually, almost humans don't trust each other. Do you have the virus or do you have the virus? No. So it's a little bit different now, but you focus on rents. Like, for example, I gave my tenant free rent for the entire year and said, you don't have to pay it back. Some of us that have done really well financially can do that. So the United States government, while unemployment rates are still high, can fiscally just give a little bit more so we could get past, and we're not talking about 2 or 3 years. We should be able to be in a better spot in 2021. So it was a very headline risk, of course, but for the most part, renters have been giving their payments because of the fiscal stimulus. The evictions, I just don't think that they're going to pull the plug and all of a sudden these headlines are going to start to come out that all of these people are getting evicted from their homes. Just in an election year, it's not going to work well. And in 2021, that's why I say, let's see who wins the White House. And, again, another eviction headline, millions of Americans losing their rental homes. It's just not the same as the housing bubble years where credit and debt and banks were in trouble. But that is the trouble group. That's why I've always focused on that. I always said renters are the people that need the help. Commercial real estate is a completely different story. That's got more issues than anything. But for the human response, it is renters. And those are the people that need most of the assistance. Homeowners have better financial profiles than renters. They also have more levers they can pull. So if you had to pick a side, I'm not too concerned about homeowners versus renters because some of these people are already stressed to start off with before this. And now, of course, the majority of the job losses are what we call second wage earners, lower income people. That's the trouble group. We focus on that. I think we can handle that if we're positive enough and can do some things, and we push it until we get a vaccine. And then once people can walk the earth freely, that last group of people that are unemployed should be able to get their jobs back.
Right. So we have tens of thousands of realtors and lenders, and if I were to pick your brain, and you've been fortunate enough to play your cards right in the mortgage game, played some stocks right, you're retired. Kudos to you, man. Some of us are still working. So what advice would you give us? It sounds like you're very positive on housing, so I'm sure the realtors would love to hear your predictions and how you'd maybe advise them moving forward. Originators, all they're doing is picking up refis off the floor because they're just raining down from the heavens. Yeah. I do want them to look a little bit past what's happening right now because I think that they need to have some long-term vision here. But what would you say to both realtors and lenders right now for the future moving forward, the end of 2020 and 2021?
Okay, so when the economy gets a little bit better, the 10-year yield should rise. The rate and term refinance boom is gonna end in that regard. So it's gonna be a purchase market. Now you got to remember, when I say this is not a joke, we have the biggest housing demographic patch ever recorded in history, and these people need homes. So ages 26 to 32, and then on top of that, if people need to move, right, either they move up or they move down, you add those two together, you have a healthy housing market, not a record-breaking demand or no homes, nothing like in that nature, but you have a stable demographic demand right there. Conspiracy theories have told you that millennials don't buy homes. Not true. Millennials are the biggest home buyers in the world right now. The student loan debt crisis, nobody could buy homes. That didn't happen. Look at right, housing is the most outperforming. Just know that housing has moved for demographics and mortgage rates. Those are the two primary drivers. Right now, they're good. When the 10-year yield gets above 1.94%, things can cool down. We saw this twice in the last expansion when the 10-year yield got above 2.62%. So when mortgage rates get above 4%, let's see how the housing market acts then. But you can't, demographics is the most powerful economic force in the world. And not all of these young people are gonna be homeowners, but some of them are, especially when they get married. See, I've always told people this: you rent, you date, you mate, you get married. 3.5 years after marriage, you have kids. This is why housing was going to be a year's 2020 to 2024 story, because we have this massive demographic patch and people get married in their 30s and have kids then. They're there, right? Hungry hippo, go fight for them. Right? Yeah. 2005, 2007, if I was here talking, I said prime age labor force is about to decline. Even without the housing bubble, things were going to slow down. Not this case. And I've been consistent about that for the last 10 years. This is the period of time where you just got a lot of people that need a home. So they're there. Mortgage rates do impact demand, especially if they go above 4.5%. People say, well, I bought my home in 1981. Nobody cares you bought your home in 1981, 16%, all right? Things are different now. So the rate of growth actually gets challenged. Doesn't mean housing is going to collapse, but the rate of growth can challenge. So always be mindful of mortgage rates rising, even though they're historically low. But just realize you've got the best demographic patch ever recorded history. And this is why the United States housing market, in a year that everyone thought was going to crash, was the most outperforming economic sector in the world. So be skeptical of the housing bubble boys, the forbearance crash bros. any gold bug or anti-central bank person believe in people that are nerdy, boring, and love economic models. They will stay in the lanes, right? They will stay in the lanes and tell you the truth.
Well, that reminded me of an interview that we're going to post down below. It's like a 7-minute interview with you and Bloomberg. It was really good. It's bite-sized. I think it's 8 minutes. So, guys, we'll post that. You got to listen to that as well. You got to subscribe to his website. We'll put that link below as well. We'll put the link to the articles, America is Back. And I want to highlight how you ended the article because I loved it, man. And this is a great way to end our interview. And I thank you so much for being here with us. But you wrote, love each other, fight for one another, don't fall into the darkness and hate. One nation, one family. We are all Americans, and this is our home.
Yes, look, 49er fan and the Seahawks fan.
Right?
Here right now. There you go.
It can happen. We can do this.
Yeah, yes.
Logan, man, I hope you come back on the show. I've really enjoyed having you on the show, and you've had you do your math, you show your homework, and I love that. I love what you said about, what did you say, nerdy is cool? Because I'm the guy nerding out on mortgage graphics all the time, and the guy that actually gets the Fannie Mae stats and sits there and reads them. That's me as well. So I appreciate all your work, man, and I appreciate being on the show and really putting this together like within a day. So I really appreciate it.
My pleasure. My pleasure.
Hey guys, we'll see you next week. Thanks again to Logan, guys. And if you have any questions, put in the comment section. All the resources that we mentioned today are going to be down below. See you guys next week.